On the 14th of November, Berkshire Hathaway's 13F filing was published, showing that Warren Buffett bought $4.3 billion worth of Alphabet stock, making it Berkshire's 10th largest position to date. This is a controversial move that left many investors wondering why did the legendary investor decided to invest in the tech company amidst concerns of a tech bubble, especially given Buffett's historical avoidance to invest in the tech industry. So in this video, I will do a full analysis of Google's business, the risk that it faces, its competitive advantages, analyze how effective is the management of the company, and at the end of the video, I will do an intrinsic value analysis of the company to determine what kind of future growth is Buffett expecting from Alphabet and why. This analysis will conclude if it was indeed a risky speculative investment as many anticipate, or a well-calculated long-term decision typical for the legendary value investor. Well, to begin, Buffett has previously acknowledged that Google is a wonderful business in this interview.
Here we saw value in something at that time. I have no idea what we're paying per click now, but we were paying $10 or $11 a click for something that had no cost of goods sold. And we were going to keep doing it. I mean, we could see that. So I should have had more insight into that. Now, whether Bing was going to come along or other people were going to take away the market, that's another question. Whether you had sort of a first user advantage that would prevail. And there is a lot of technology to it. So somebody could have come along with a better technological product, and I would not have had any insights into that. I certainly had insights into the benefit to the user. Just imagine having something every time you just hit a click, you know, the cash register rung somewhere out in California. So it was and is an extraordinary business, and it has some aspects of a natural monopoly. I mean, it's very easy for me when I go to the computer. I've worked with Google before, but I'm looking for information for the annual report. I used to have to mail away to federal agencies or go down to the public library, and now I can get it in 10 seconds. So it's a hugely valuable device, which the other guy pays for. The user on the computer doesn't. Yeah, the answer is we missed it. And I knew the fellows. They came to see me before they did.
Sergey and Larry came to see you.
Yeah, and actually Eric did too.
And Eric.
Yeah. I liked him.
So in this clip from 2017, Buffett acknowledged that he missed an opportunity that he understood well enough to execute on, meaning that he is actually quite familiar with the business and how it operates. So firstly, I will explain the company's business model, its offerings, and how it generates revenue. Alphabet Incorporated provides various products and platforms all around the world. It operates through three big business segments: Google Services, Google Cloud, and other bets. Google Services is the main company segment, which generates around 86% of its entire revenue. However, the segment itself is split into two separate categories. The bigger one being Google advertising business, which are all revenues generated from advertising on their platforms, which itself accounts for around 75% of Alphabet's revenue, meaning that the company currently makes 3/4 of its revenue from ads, split between Search, Google Network, and YouTube ads. Google Search earns most of its money by showing ads alongside relevant search results on google.com, so advertisers are being charged on a so-called pay-per-click basis, so whenever someone clicks on an advertised search result, Google makes money. Google Network includes revenues generated on Google Network properties participating in AdMob, AdSense, and Google Ad Manager. Google places relevant advertisements on these external member properties and shares the revenue generated with the publishers on a pay-per-impression basis. And lastly, YouTube Ads mainly generates revenue from advertisements displayed on videos. The second segment is called Google Other Services business, split between consumer subscription, platform, and devices, which accounts for around 12% of the company's revenue. Consumer subscription primarily includes revenues from YouTube services such as YouTube TV, YouTube Music and Premium, and NFL Sunday Tickets, as well as Google One. Platform mainly includes revenues from Google Play sales of apps and in-app purchases. And finally, devices first and foremost include sales of the Pixel family of devices. Moving forward to the Google Cloud segment, which includes two key services: Google Cloud Platform and Google Workspace. Cloud computing allows individuals and businesses to do computing over the internet by using a company like Google's physical servers. Google Cloud Platform provides businesses with tools and infrastructure to build, test, and deploy applications. For example, businesses can rent virtual machines that run Google servers to perform high-end computations. And Google Workspace is a suite of business management tools such as custom email domains, cloud storage, and other business features for Google services. Last quarter alone, Google Cloud generated over $15 billion, representing close to 15% of total revenue. Cloud is Google's fastest growing revenue segment, and for many years after its introduction, Google was losing money from it, since it wanted to gain market share in an industry which was led by two giants and a few other smaller competitors. But that bet is now paying off, since from the beginning of 2023, Google Cloud now started having positive profit margin, which are growing at a significant pace. Moreover, last quarter, the company registered an impressive $155 billion cloud backlog, which represents the total value of future revenue to be collected from existing customer contracts that Google Cloud expects to recognize over time. Meaning that a lot of new customers are signing long-term contracts with the company, signifying that many companies are shifting their business to using Google Cloud rather than other competitors. One of the reasons being the company's advantage in AI offerings on its cloud products, which I will tell you more about a little bit later in the video. Finally, the last business segment that Alphabet has is called Other Bets, which include businesses that are at various stages of development, ranging from those in the R&D phase to those that are at the beginning stages of commercialization. And the company's goal is for them to become thriving, successful businesses. Although some of them already produce revenue, they represent only a very small part of the overall revenues, with the whole category earning less than 0.5% of the entire Alphabet's revenue. Some of Alphabet's biggest other bets are Waymo, a self-driving taxi company, and Calico, a biotechnology R&D company. In Q1 of 2025, the company reported that Waymo already has 250,000 weekly rides, with some estimates in November 2025 suggesting that the current figure could be as high as 360,000 weekly trips based on recent growth rates. So now you should have a good understanding of all of the different ways that Alphabet generates revenue, which have a very strong and somewhat diverse business model. However, as such, the company experiences fierce competition and faces a lot of different risks to its business, so I will now perform an analysis of its competition and main risk factors. So I'm not going to go in depth about Google's Other Bets category, since it represents a very small percentage of the entire revenue pool. But I'll be starting with Google's cloud business, since this segment faces a lot of competition from different companies, but the two biggest are Amazon's AWS and Microsoft Azure, who lead Google Cloud in terms of market share. The good news is that Google Cloud is the fastest growing and is slowly eating away more and more market share, especially from AWS. But regardless of that, AWS is still the leading cloud provider with a substantial margin and more than twice the market share compared to Google, and Microsoft Azure is also growing even if it's not as fast compared to Google Cloud. Continuing with Google Other Services business, in terms of Alphabet's device category, we see a similar situation where Pixel is the fastest growing brand and is eating away market share quarter after quarter. However, it still faces two giants, Apple and Samsung, who have led the market for more than a decade. Regarding the Google subscription business, I'll be mostly concentrated on the YouTube subscription part, where they compete mainly on music and streaming offerings with the YouTube Premium subscription. In music, they control a small percentage of the market through YouTube Music. However, in streaming, there is something very interesting to be observed, especially comparing it to the subscription service like Netflix, Prime, and other similar streaming services, where YouTube can be seen consistently gaining percentage of TV viewership time, which was not common in the past. But recently, people spend more and more time watching YouTube on TV compared to other streaming services. In terms of platforms, the most relevant ones are Android, which has Google Play as its main app store, and Chrome, which is Google's own browser, both of which currently own more than 70% of their respective markets. So what is left is the Google Services business. So YouTube business model itself does not have significant direct competitors, however it does compete on watch time. So to give more information about its dominance, YouTube is the second largest traditional internet search tool in the world only after Google search itself. Speaking about Google search, here is where things get interesting, since in the traditional search engine, Google owns right around 90% of all of the search volume, followed by Bing, which currently has a bit more than 4% of the market share. Where the most searched thing on Bing is google.com. But the reason why many investors worry about Google search dominance is due to the introduction of chatbots like OpenAI's ChatGPT, which managed to reach 100 million users in just 2 months after its release, and now the chatbot has claimed to have 800 million weekly active users, which threatens the main economic moat of the company, and it is that search dominance, something that Warren Buffett is very keen on. So let's look at the risk factors of the company, starting with exactly this one, and it is how AI chatbots threaten Google search dominance and its entire revenue generation model. So as mentioned, Google generates 75% of total revenue from online advertising, majority of which, as explained, happens when someone searches or sees something on Google and clicks on an ad that appears as a result of that search. So a reduction in search traffic due to a switch of user preference toward chatbots could temper their internet search advantage, and advertisers might stop spending money on Google for ads and look elsewhere, such as move their ads to platforms like Meta's Instagram and Facebook, TikTok, X, or to some other advertisement channel. So the company needs to continue to innovate and provide products and services that are useful to users, customers, and other partners. What Google does in response to that threat is they expand their investments in AI across the entire company. This includes generative AI and continuing to integrate AI capabilities into their products and services. And the main way that this happened is by challenging ChatGPT with their own latest AI chatbot called Gemini 3. In the beginning, when the company introduced its first model called BART, it fell short of expectations and the company was falling behind its competitors. However, for the last 1 year, it managed to bounce back and went from having just 90 million active users in 2024 to 350 million in July of 2025 to now reaching 650 million users in November. Probably the main reason for that can be attributed to them being able to catch up with the progress and innovation of other chatbots and AI tools like video and image generation. According to the website LM Arena, which evaluates artificial intelligence models through anonymous crowdsourced comparison, meaning that the users compare and rank the answers of the prompt without knowing which platform generated it, it shows that the latest Gemini 3 Pro model surpasses all other current models on average between different categories, such as solving math problems, answering hard prompts, programming, and so on. But even if Gemini becomes the most used chatbot, a big worry is that this can interfere with the current way that this business segment operates. The company has integrated the tool into the search engine, however many investors worry that this will change the way people interact with the search engine, resulting in them basically not clicking on as many ads. This can already be noticed slightly, since one of their business segments, Google Network, is already experiencing some stagnation in its revenue growth. However, there might be a sign that despite the worries from investors, the Google business model may not be threatened, and it is something that Warren Buffett probably also saw when analyzing the company. But I'll explain it later in the quantitative mode part of the analysis. The second biggest risk factor that the company faces is something that I believe was another major reason to keep Buffett from investing in Alphabet so far. And it is the regulatory antitrust and privacy changes, which are a significant threat to the Alphabet's business. So Google was sued from the Department of Justice, which claimed that it was running an illegal monopoly in the online search market and wanted to force Google to sell its Chrome browser. However, in September, the US District Judge Amit Mehta rejected the breakup proposal and ruled against the sale of the Chrome browser. Interestingly, right around that time is probably when Berkshire started buying Alphabet's Class A voting shares, which means that Buffett concluded that the sale of Chrome could have been a major hit on Google's competitive advantage, and when the case was settled, he probably started buying shares of the company. I am not saying that this is the main reason he bought the stock, but it was probably the last hurdle that he wanted to pass so he can evaluate the future of the business. That is not to say that the Alphabet's business is fully safe from regulatory challenges. The EU and US strict data and privacy laws will most likely still result in future fines and restrictions. But maybe the risk in the near future is not as high as from the settled case with the DOJ. The last big risk that I can see the company is currently facing is that in the last years, its huge AI efforts and infrastructure building therefore has resulted in a high capex expansion estimated at around 77.9 billion total capex for the last 12 months. Even though this spending has clearly helped the company to gain market share in the AI race, it is not certain that this high spending will directly translate into more revenue growth in the future. But it may at least result in the company being able to keep its moat, which I'll now move over to, so we can understand exactly what makes Alphabet's business likely to retain its position as a leader in the industry and not be taken over by competitors in the future. Something that Buffett looks very closely at when evaluating companies. The first one being Google search and YouTube's networking effects, which allows it to attract exceptional number of advertisers. The networking effect basically means that the more users a network has, therefore more people creating content in the case of YouTube or offering services in the case of search on their platform there is, and the more people come to use this service because of that and so on. This creates a positive feedback loop which makes it harder for competitors to take over, since all of the users and good content is already in the existing platform. This can be proven with the high growth that those businesses still experience, since search continues to show double-digit revenue growth with more than 2 billion users of AI overviews. While YouTube still leads in streaming watch time in the US and achieves high engagement with shorts, averaging over 200 billion daily views. The second mode that the company experiences is the high switching cost, which makes it very hard for users to switch from one service to another, either because there is a very high cost or since you have already invested yourself in it, so moving will be very difficult. For example, in the case of Google Cloud, it is very costly and time-consuming for a big enterprise to move all of its data, processes, and require all of their staff to learn a different platform. So it is easier to just stay with your current one. And for users, services like Gmail, Google Accounts, the Android ecosystem integration, and many more makes it much harder to move from one service or product to another. You cannot just move your emails from Gmail to another email service, or if you are used to using the Android interface or own wearables which are compatible with the Pixel ecosystem, it makes it harder to just switch brands. There is another mode which is not something the consumer always sees or notices, since it is the intangible mode that the company has, such as the technological expertise and the complex algorithm that the company possesses, which is not something other companies can simply duplicate. And let's not forget the brand of the company, where the phrase "Google it" has turned into a verb meaning searching for something on the web. One final smaller mode I want to mention quickly is something that happened more recently, and it is related to the cost advantage mode, where Google now claimed that their entire Gemini 3 model was trained using only Google's self-made TPUs, instead of NVIDIA graphic cards, which may not be necessarily better, but are much cheaper in comparison, and now even Meta is in talks to spend billions on Google's TPUs. So in a world where everyone pays for the extremely expensive NVIDIA GPUs to train AI models, having an edge in costs is a huge advantage for the company moving forward. So now, I want to talk about something that I believe to be the main reason that proved to Warren Buffett why the search business revenue generation capabilities are most likely not at risk even after the high amounts of people using chatbots as an alternative to search. And it is part of the qualitative mode of the company, which showed that despite investors' worry of users fleeing away from traditional search, has produced different results. Since after ChatGPT's introduction in Q3 2022, the revenues from Google Search alone has increased from 39.5 billion in the same quarter of 2022 to 56.6 billion in Q3 2025, exactly 3 years later, having an amazing 43% increase. And even more astonishing, the operating margin of services in Q3 of 2022 was sitting at around 32%. Fast forward to Q3 of 2025, that number now sits at around 38.5%. And if you exclude the one-time fine from the EU Commission, it jumps to 42.5%. So I think this clearly shows that Google's moat is strengthening rather than weakening, proving to Warren Buffett that the company's search revenue will likely continue to grow into the future. Part of the reason being that the company managed to smartly integrate the AI overview functionality in search, so that it continues to show ads to people and they still click on them. But mainly, people primarily use chatbots for creative writing, complex questions or programming, whereas search is still used as much for high-value commercial searches like shopping, traveling and local services. There is one last thing that Buffett pays a lot of attention to before determining the future growth rate and intrinsic value of a company, and it is how effective the management is, which includes the ownership structure of a company, their compensation, how they manage the company's debt, and how effective they are in reinvesting Alphabet's capital into growing all of its businesses. As of November 2025, Larry Page and Sergey Brin beneficially owned approximately 85% of the Class B stock, which represents approximately 51.4% of the voting power of the company. Some companies like Alphabet have multiple classes of shares. Alphabet has three classes, A, B, and C. The current CEO of Alphabet and its subsidiary Google is Sundar Pichai. He holds a combination of over 2.5 million Class A and C shares, worth close to $850 million as of writing this video. The CEO compensation at the end of 2024 was a combination of base salary of $2.5 million and equity awards worth around $8.7 million. The CEO and all other executives earn a high amount of their compensation in shares, so their decision-making is likely to be dictated by driving high total shareholder returns. This is all great, but let's see now how effective they are with reinvesting the company's capital back into the business. To do that, I look at the return on invested capital figure, which has been extraordinarily high for the last 10 years, and even more impressively continues to rise over time. Usually, Buffett looks for companies that have a minimum of 10% ROIC, which preferably grows or stays stable over time. So such high numbers as in Alphabet's case signify a management that is exceptional with reinvesting the funds back into the company. The other thing which Warren Buffett considers crucial is looking at the company's financial health, which shows if a company can withstand bad economic times and evade bankruptcy. So the two figures that Buffett always looks for are the current ratio and the debt-to-equity ratio of a company, where a high current ratio shows that the company will have no problem paying out its short-term debt, so we are looking for a figure higher than 1, where Alphabet clearly fits in that criteria. And regarding debt to equity, which means how much debt does the company has relative to equity, Buffett looks for companies that have this figure under 1, which means that most of their funds does not come from debt, so they are not reliant on it, showing us that they can easily run their operations in times of high interest rates when it is much more expensive to borrow. In the last about year and a half, the company started borrowing a lot, which is probably because of its big capex spending on AI infrastructure, but with a healthy balance sheet like theirs, I'm not too worried about it. So there we have it. We have now analyzed the company according to Buffett's value investing principles. So now it's time to determine the current expected growth of the company by the market, as well as what Buffett is expecting the growth to be, based on his recent purchase price of the stock. So the most common way to find the intrinsic value of a company used by most value investors is by using the discounted cash flow method, which is a financial model that calculates what an investment is worth today by projecting its future cash flows and adjusting them back to present value using a chosen discount rate. So I won't get too much into detail about how this is performed, but if you want to learn how to do it yourself, check out this video where I explain it in details. But what I will do is reverse this calculation and show you what investors currently estimate the future growth of the company to be based on the current price they are willing to pay for it. So if we assume that investors are requiring a 15% yearly return on their investment, which is very common, and a 4% terminal growth rate after the 10th year, that means that investors speculate that Alphabet will grow at 19% per year for the next 10 years. at the current stock price as of writing this video. At first glance that might not seem too extraordinary for you, but if you look at the historical performance of the company, you can see that for the last 10 years, the company was growing slightly below that rate at 18.6%. While it seems logical to presume a company the size of Alphabet is going to continue to grow with 19% might be a bit too optimistic. However, in Buffett's case, we can see that he actually bought at a lot lower price, which can be seen by taking the average price for the quarter he bought in, which is about $209 compared to $320 as of writing. Meaning that by using the same method, it shows that Buffett was expecting a much more sensible 12.5% yearly growth rate for the next 10 years. However, I want to mention one more thing, and it is that even though free cash flow is the most common figure used to estimate the future value of a company, in the past Warren Buffett has claimed that he has a bit modified figure called cash flow for owners, which is almost the same as free cash flow, but it does not subtract the entire capital expenditure, but only the amount used for maintenance, which does not include the funds used for growing the business. Additionally, he uses a margin of safety, which means he is often buying the stock below the intrinsic value price to include a margin for error. Now, estimating the capex used for business growth is not something that Alphabet reports in their annual report. However, what we can do is try to estimate it. And by looking deeper into the report numbers, we can try to estimate this using D&A costs alone, which gave me a 24% of capex used for maintenance and 76% for growth. However, as I mentioned earlier in the video, the data center construction may not fully pay off monetarily, so I will therefore go with the more conservative figure of 50% used for growth. So after running the models, I came up with two growth estimates, one having a 25% margin of safety and the second one having a 50% margin of safety. Meaning that Buffett probably expects a yearly growth somewhere between 10.5% and 16.5%. Which is lower than what the market currently projects at this price, even with a meaningful margin of safety. If you want to learn more about Warren Buffett's and other value investors' investing principles, check out these videos where I explain this in details. Thank you for watching and see you in the next one.